Hello and welcome to GoodGood Investing. I'm Rachel Grunn.
And I'm Andrea Cwik.
Thank you guys for joining us for another week of GoodGood Investing talk. And then just quickly at GoodGood Investing, we provide education and passive investment opportunities for busy professionals and successful entrepreneurs that want to diversify their portfolio and retire early.
And make money while they sleep.
Sounds good to me. Sign me up. So this week, we are going to kind of be talking about the forecast for 2023. So I know by the time this episode's released, we are into Q2 of 2023. And a lot of people are uncertain about what's ahead. I know as of recording this, it's mid-March right now, and the past week has been very shocking in the banking industry, truly. The SVB collapse, and then the takeover of the Signature Bank in New York City from the FDIC. And the current presidential administration has tried to instill hope back in the consumers by saying that they are stepping in to stop this chain of events, and they're not doing so in a way where the consumers are going to have to pay for it, but they're actually bailing out these banks through insurance funds that banks pay into the FDIC for that insurance that they have to carry as a bank. So hopefully the trend stops. It's kind of a self-fulfilling prophecy, right? People get freaked out that the bank's going to fail. Mm-hmm. So what do? They pull their money out, which causes the bank to fail. Anyway, so there's a lot of discussion about what 2023 looks like, and we're going to kind of get into it. What does the commercial real estate space look like right now? So of course, interest rates are rising, which is killing a lot of deals.
Yeah, and some people think that, well, there's been articles out there that interest rates are going to keep rising up until like even next year. But what is the truth? Because nobody knows. No one has a crystal ball to be like, next year they're actually coming down. But what do we know? Let's focus on the facts.
And I do know that I hope that the SVB collapse has woken up the Fed a little bit, and hopefully they slow down on the hikes. But anyway, what do we know? We know what is happening today, and that's it. Mm-hmm. And that is exactly why in our deals and in our underwriting, we bake in a lot of very conservative estimates. We raise money for interest reserves that we may or may not need to use just to have them there. I mean, that's all we can do is just prepare for the worst, hope for the best, and if the worst happens, form a contingency plan and execute that.
Yeah, and I think we all realize that investing in general there's some risk involved, but then nobody really thinks if you keep your money in the bank, that also is at a risk because you're only insured up to, I think, $250,000 by the FDIC. So you want to put your money to work somewhere where it's a little more stable, or at least in my mind and for my family, we're looking at hard assets because the stock market has been a roller coaster. So investing in the stock market, we lost a lot. So where in hard assets can we be moving our money to that feels a little more secure so that you at least have something to sell at the end of the deal?
Exactly. And just for those of you, and I might be dumbing this down too far, but just for those of you that aren't exactly sure how banks work, whenever you deposit money into your bank, it's not just sitting in a vault, right? They invest your money. They deploy your money. They use your money to issue loans. So your money is being worked in the bank, right? And they have a fancy algorithm where they can decide how much they really need liquid depending on how much actually people pull out. When banks fail is when people withdraw more than the bank actually has, at the facility, not invested. So that's what happened with SVB, the Silicon Valley Bank, is that too many people withdrew at one time and they didn't have the funds to satisfy those withdrawals. So because they had invested them in bonds and the bonds had lost value, and that's kind of what caused this sequence of events. So to Andrea's point, when you invest in a hard asset like real estate, that money is in that asset, and that asset is physical. It's a real thing. Mm-hmm. There's not just this mutual trust that you have with a bank that hey, I'm depositing my money here in good faith that you'll have it there when I need it back. That's not the same thing. It's a hard asset that we can always sell if worse comes to worse, recoup your money, and hopefully not at a loss. I think it would be hard to sell at a loss because of the nature of real estate, right? So anyway, that's all to say, what is happening because interest rates are rising? Distributions have all but completely stopped, right?
Yeah. We're in several deals, and at this point, we don't see any cash flow on a quarterly basis. But so far, that's kind of the worst, quote unquote, that's happening to us, which we're fine with, because for us, it's the long-term play. We're looking more at the appreciation. So once our deal sells, can we get our money back in some? At this point, any above what we put in is a win, in my opinion, because everything else has lost.
Yeah.
So we're looking really towards that 3 to 4 year mark, and we know that, our money is tied up until that point of sale, and the cash flow is just icing on the cake at this point. But for me, I'd rather have our general partners keep that for reserves, just in case they need anything with, the interest rates rising and all of that. So I'm perfectly fine with the stop in cash flow, but it is something to be aware of.
Yeah, definitely. And I think a lot of people might believe that if the cash flow stops, that means that you're losing money, the investment's doing poorly, it's all, doom and gloom. It's not the case at all. A lot of times people stop cash flow just to keep cash reserves high, to be super extra uber conservative. For instance, cash flow stopped at the beginning of COVID, whenever we didn't know what would happen with the moratoriums, people not being able to rent, people losing their jobs. We stopped distributions, but guess what? Those investments ended up selling 3x in 18 months. They did the best ever.
Yeah.
So that has nothing to do with how the asset's performing. And with like Andrea said, her play right now is the appreciation, which is, it's where everyone makes the most money, is on the appreciation. Equity doesn't hit your bank account. When the property is building equity and gaining value, you're not seeing that in your bank account. That's not realized till the sale. And I think people kind of need to understand that, especially right now as distributions are pausing, is that doesn't mean that you're not making money still, because you're not going to realize the real return until the sale of the asset.
Yeah, absolutely. And I think also, and our investors are super educated, and they, know this by now, that when you go into a deal like this, it's for the long run, right? We always talk about investing in a hard asset, commercial real estate. It's like a flip, but it's a long-term hold. So we can expect to get into a deal and then right away see everything as a positive thing, right? We have to stabilize the asset. So sometimes that means spending money. Sometimes that means occupancy gets lower. But the true thing is, when you're looking at all of the results that come in a monthly basis in that monthly report to you, even if it looks negative, we're turning it around. We need time to stabilize. And so our investors, please, have patience when you're looking at those reports. And if you see anything, always, ask us questions, and also know that we are in it for the long term, not the short term.
Exactly. And who's to say, like we said at the beginning, who's to say what's going to happen next year, what the landscape's going to look like. So it could be very exciting. So I think heading into 2023, it's going to be really hard just to make investments that are leveraging debt make sense right now, just because of how expensive it is to borrow money. So we are really focusing on alternative assets right now that are either debt-free or have really interesting lending terms that don't expose it to the traditional debt market. So I think going forward, maybe your traditional multifamily won't make sense, or if it does, just make sure the operators are being very conservative. And otherwise, I think looking for assets that are being bought with cash would be kind of the way to go for 2023. What do you say?
Yeah, and Rachel and I are always looking for deals. So if we see good opportunities, and maybe we'll see some in multifamily, but we just have such strict requirements, and we want to be really conservative, because We want to bring our investors really good deals and deals that we put our money into.
That's it.
So, we're going to be very choosy on the deals we bring, but the ones that we do bring to the table, they're going to be good ones.
Tuned. Well, guys, definitely get in touch with us if you want to be in the know on what we have going on in 2023 and beyond. We're really stoked about the opportunities we're going to be presenting to you guys. So get in touch, schedule a call with us. You can do all of that and more on our website. But until next time, don't invest good.
Invest twice as good. Bye.